the 360 on Energy and Carbon podcast, hosted by 360 Energy. On today's episode, we are joined by James Williams, one of 360 Energy's senior analysts with 10 years experience in the industry. He's an expert in electricity and natural gas commodity markets across North America and ensures clients secure the best possible pricing and contract conditions from suppliers and utilities. He provides regulatory advice to clients regarding Ontario's former cap-and-trade system and current emissions performance standards program, while considering the Canadian federal carbon tax and output-based pricing system. Now on to the episode with James. Welcome back, Dave and John, and thank you, James, for joining us again this week.
Great to be here. And James, thanks for coming back to us.
Yes, happy to be here.
So to kick off this episode is all about the natural gas market pricing spike. And I know there's been quite a few articles out there. I know it's been the talk of the office as well. So what is the history leading up to the natural gas pricing spike, and what are the conditions of the market today?
So gas pricing, and this is going back the past, really since 2008, but really the past 10 years, gas pricing has generally been in a downtrend as we see the implementation and increased investment in shale gas production or fracking, which comes at a particularly low price point. And as there's been more investment in it, that price point has been getting lower and lower. So producers are able to produce gas at a substantially lower cost than they had been, at in 2005, 2006, 2007. So gas pricing for the longest time has been in a downward trend. There have been the odd blips, primarily weather related. For example, back in 2013, 2014, when we had that polar vortex that came through, the first polar vortex, we saw gas pricing spike. We've seen it spike in the winter months a couple of times in response to particularly cold temperatures, but it has generally dropped back off then and been dropping for quite some time. And when we're looking at gas pricing, particularly at AECO here in Canada, that pricing had been at points negative because of some supply or constraints where they didn't have the ability to export gas, the pipeline constraints. So they were producing gas and it was just being stuck at AECO. Wasn't able to go anywhere. So we had seen pricing drop as low as negative pricing, but had been typically around that $2 per gigajoule mark. And now we're starting to see that price increase pretty substantially over the past year. So getting into that, the some of the reasons for that price spike, it starts off typically with what we've seen in Texas. As I mentioned, with winter weather back in February, where we had a particularly cold spell hit the central U.S., all the way down to Texas. That had a kind of a two-level effect. One, it increased demand for natural gas pretty substantially across the central U.S. in places that aren't typically heating regions, such as Texas. But then it also had an impact on production because Texas wells aren't built for the cold. They aren't, or I guess, drilled for the cold. They don't have the same kind of weather protections that, a well in Pennsylvania might have. And that led to the wells freezing, as they weren't able to produce as much gas in February as they had been previously. That pushed prices higher kind of as a one-off in February, and we saw prices drop back in March and April, and not quite back to where they had been before and where we would expect them to be, but they were substantially lower and just on the high end of what we would consider the normal range for pricing. And then we hit June after a period of relatively normal pricing, and we got a substantially hotter June. I believe it was the hottest June on record for the US, and across much of North America, it was particularly hot, and that increased power generation. And particularly in the US, they rely on natural gas generators in many markets, not only to provide generation, but particularly to provide that kind of marginal generation when you're getting near the grid capacity. So as power demand increased, much of that demand was being served by natural gas generators. And that limited the amount of natural gas that was going into storage. So typically what we see in the gas markets is this pattern of emptying gas from storage over the winter months because you're using more gas than is being produced to meet the heating demand. And then in the summer months, you fill that storage back up because you're using less gas than you're producing. And because of what happened at the beginning of June, gas ended up in what we would consider a deficit position. So there was less gas in storage than what we would normally see at this point of the year because more of that gas was going to these power generators. And then we hit July and August, and we had relatively hot Julys and August. They weren't record breaking, but they were top 5 summers or months in terms of heating demand or heat and what we'd consider cooling demand or the demand for power generation to provide cooling load, air conditioning. And so we saw gas keep going into storage. We didn't have any what we consider withdrawals where we were taking more gas from storage than we were putting in, but it wasn't increasing at the same kind of rate as we normally saw. It was relatively close, but not refilling nearly as quickly as everyone expected. So that means that currently, as we're coming out of the summer, when we typically, fill up our gas storage, we have less gas in storage than we normally do. Another contributor to that was the increase in LNG export capacity and LNG exports across the board in Europe and Asia last year. We saw a colder than normal winter, which increased the amount of gas being used and left their storage levels lower than expected. And that has pushed gas pricing higher as they're trying to fill that storage level back up to where it should be. So they're willing to buy gas at just about any price to make sure they have enough gas for the winter. And so that's increased the appetite for North American gas in the form of LNG, which is liquefied natural gas. And that's had 2 factors on gas pricing here. One, it's increased the demand for gas, which pushes the price higher. And 2, it sets the benchmark price to compare North American gas to higher because you're looking at why would I sell gas to North American company for $2 a gigajoule when I can sell it for $16 a gigajoule in Asia or in Europe. So that kind of sets the benchmark higher and increases the demand for gas here at the same time. So that those factors have all kind of combined. The Texas cold, the hotter summer and higher gas use for cooling load, and the increased gas being exported overseas have all kind of combined to push pricing higher here. And it's also combined to limit the amount of gas in storage so that we are entering the winter with what would be considered below normal storage levels. Now, those storage levels are still safely within what we would consider the 5-year range. So the 5-year maximum, the 5-year minimum, and actually pretty comparable to what we've seen in a couple of years pre-pandemic. So 2018 and 2019, they aren't terrible storage levels, but they aren't normal either. And that's what that's raising concerns about what happens if we get a cold winter. And some of that fear is now being added into the market that if we get a particularly cold winter, we could see storage drain to a level where there's concerns about supply. So everyone's buying gas now to make sure that they have gas supply over the winter, and it's really kind of pushing prices higher as everyone starts buying out of fear ahead of the winter.
It comes back to in our last podcast where John was saying it was geopolitical in Europe. Well, actually, because there's a shortfall of gas in Europe because it was cold, but also Russia's not delivering the gas. And then the other issue, so climate change, James is talking about how it impacts things in Texas. Well, also in Europe, climate change, they don't have the wind generation, John, so they're using natural gas to fulfill that, and they're using North American gas. So we're now talking about a worldwide market when, before we were really isolated towards North America. So it's changing dramatically. And then add on top of that is when this pandemic occurred and oil pricing dropped heavy. A lot of natural gas comes from a byproduct of oil drilling. And so when the producers it didn't look like they were going to have the money or getting the price for oil, they didn't get the financing to drill for future activity. So even though we have production now, there's concern that there may not be future natural gas production because the producers aren't producing or won't be producing the gas because they don't have the money to finance for drilling. So it's all tied in together. So it's kind of a perfect storm that's occurred that's driven this market crazy.
Yeah, and it is important to note that gas storage, as I mentioned, is still within a reasonable range. It's not as high as we would like, but it's not at record lows or even at 5-year lows. It is somewhere between those two ranges of the 5-year average and the 5-year low. We have been in this position before in terms of gas storage, and we haven't seen nearly the same kind of volatility. And it's actually somewhat impressive and shows you the strength of production we've seen, especially in the US and in Canada, that we had this kind of perfect storm of factors, the Texas storm, the particularly hot summer, and the increasing LNG exports. And we are in a relatively normal storage position still after the summer, even despite all of that. And we are looking at going into the winter with potentially 3.5 billion cubic feet or more in storage. And some of that will come down to what the weather looks like for November. We typically see injections continue into November into storage. And if we get a particularly warm November, that extends the period where we can see injections. And that is what the NOAA is currently calling for, a particularly warm November. But again, when it comes to weather forecasts, it's better to be a bit skeptical and take them with a grain of salt. And that's where that fear element comes in. Is anytime someone sees a forecast for that, it's going to be a particularly cold winter, they're going to start buying gas in advance. And if you see forecast, people tend to ignore the forecasts for a warmer winter and act on the forecasts for a colder winter just because they'd rather not get caught out by the colder winter. They'd rather take the action in advance, pay that premium and avoid getting caught by a cold winter that they think they should have seen coming, than take the forecasts for a warmer winter as accurate and then be surprised. And so that's where we're seeing a lot of this volatility in the market, as we have this balance between people who have fear-based, I'll say, or risk management-based approach to, I know how high this could get if we get a cold winter, versus those who are looking at the facts and saying the scenarios that require us to get up to that price are possible, but they're fairly unlikely, right? So we're seeing this balance in the risk management perspectives of traders in the markets of, this is what the top end could be. This is where the likely range is. We've seen suppliers say, based on a normal winter, not even a particularly mild winter, but just a normal run-of-the-mill cold winter, gas pricing should drop back to somewhere between $3 and $4. Pricing for the winter currently is around $5.70 as of today's date, but it should drop down to $3 to $4 if we get a normal winter. But if we get a particularly cold winter, it could go up to $10. So you're seeing buyers saying, well, I'd rather pay $1.50 to $2 more for gas than risk paying $5 or $4 more for gas in the worst case scenario than I could have locked in for, right?
And the other thing is, because there's been a lot of chatter, people believe that it's a bull market, so you have a lot of institutions that may not even be using gas, but they're investing, they're speculating that the gas market's going to go up, so they're all piling into the market. That's actually moving the market higher as well.
Yeah.
Can I throw one in here, because we're experiencing energy spiking. Gas prices gone up, wholesale gas gone up 70% in the last month, and we're sort of trading around 180p a therm as opposed to 40 as it was. But we're having an interesting situation occur, and it may be because of our different retail markets. But we are now having smaller retail providers, utilities, are actually collapsing, because they are price capped at one level in selling to the domestic consumer, but the wholesale price has gone rocketing up, and they haven't bought smart enough to be able to survive it. So is that a possibility in the North American markets, or are your markets, because of your less deregulation, should we say, a little more robust in that sense?
Yeah, so I can't speak for all of the smaller utilities in the US. I can speak for Enbridge and Union, which are the two big utilities in Ontario. They do have the ability to pass through their increased gas costs to customers. That does go through a regulatory process to
Yeah.
where they have to justify it. They also have historically done hedging and advanced gas buying based on their expected load, so that to ensure they have gas supply for their customers. So you're seeing that their costs aren't increasing quite as substantially as the market is, because they do have a portion of that bought in advance at a lower price. When we've been seeing the price, dropping month over month over month, which we had been up to this point, you would typically see them charging a bit of a premium over the market price, because they had those forwards in place, and those forwards were slightly higher than the market rate. But that, balances out at this point when you get this period of volatility where you're seeing a substantial compared to the market price. And again, the customers here are also, especially the large customers, are able to buy their own gas supply, and that at that point the market price is just passed through. It's whatever agreement you come up with to a supplier, and Enbridge doesn't, or Union doesn't have any impact on that. And there's no price cap at what you can pay.
Mm.
So the next question I'm particularly really interested about, what are some indirect effects of natural gas pricing increasing? So what other product costs will increase? And this is particularly interesting for me because I think especially if you have any manufacturing background, you're kind of thinking, okay, now the cost, of producing your item is increased because of the natural gas price increase. But I'm interested in what you have to say on that.
Yeah, so the primary one that we've already seen increasing, and it's not necessarily a product per se, but it's electricity. We have seen electricity costs across North America increasing because, as mentioned, natural gas is a substantial source of power generation across the US and even parts of Canada. And it tends to be the source that sets the market price. And it tends to be the kind of last generator on tends to be a natural gas generator. And so as the cost of gas increases, the cost to create that power increases, and the market cost of electricity increases, and that gets passed on to end users, both end users that are on a market-based rate and end users that are in a regulatory or regulated rate, because the utilities, even with their regulated rates, still typically have mechanisms to recoup those costs. What we see in the US, particularly in regulated jurisdictions, is they have on their electricity bill a fuel charge, and that's the cost of the fuel to produce the power for them. And so you might have 90% of your bill is fixed on these regulated rates, but then there's this fuel charge adder that fluctuates with the cost to produce the power. And so that gets passed through even if you aren't in a market-based jurisdiction. Even regulated utilities can pass these costs along to companies. In terms of other industries, other products, fertilizer, natural gas is used in fertilizer, particularly in making ammonia. And we see a lot of natural gas used to make ammonia, which is then used in fertilizers. So that might be increasing. And as fertilizer costs increase, and as we see the cost of gas increased, it will increase the cost of food potentially. Greenhouses, a lot of greenhouses use natural gas for heating and to produce the carbon for the plants, and they use their fertilizer for growing crops. So as the cost of gas increases, that increases the cost to produce food, both in the fertilizer and the heating costs, and that cost will get passed down the line, especially since this increase is impacting North America wide. It's not a specific region, in North America that's feeling the impact and can be, offset by cheaper costs elsewhere. It is an across the board increase there. Other chemicals, plastics, some plastics are manufactured using natural gas, so they may be increasing. We've also seen oil costs increase as well. They've just passed $80 a barrel recently. So between the increase in oil prices and the increase in gas prices, we can see plastic costs increase because they are key components in both of those. I will open this up to Dave and John to see if they have anything else to add on top of that.
Yeah, I'll just say this because James, I think you've covered the material cost, but I'll tell you, it's going to change the landscape within an organization, because traditionally energy was not talked or spoken about normally at a senior executive level because it was pretty low, not really volatile. At least it hasn't been for at least the last 5 years. I actually think it's now moving up. In fact, we have clients now at the executive level starting to ask questions about energy that they've never asked before. So that's been a change. And I actually think this is not a short-term thing. I think this is a long-term thing, because as we discussed in an earlier podcast, fossil fuels is a big part of energy content's required and going to this energy transition, we're going to have to start looking at how we mitigate or change from the fossil fuel. So I think it's kick-started discussions at a senior level, which I think is good because it gets people looking. Unfortunately, it has ripple effects or dramatic impacts on product costing, and that's certainly everyone's going to feel that. John, what's your perspective from Europe?
I think one of the issues with this is that we need a mindset change because there are an awful lot of organisations and people regard a utility bill as an act of God. It's there. Oh, the market's gone up. We've got to pay it. Maybe this is a short-term blip. We'll suck up the cost increase for now, and then maybe see what happens. And I think you're right. More people are talking about it. The trouble is, what I find when we go through these circumstances is it's in the media, and we get, James referred to panic. We get panic taking place. Everybody's interested in it. They want to do something, and then the price collapses shortly afterwards, and they go, oh, well, that's passed. It's all okay. And I think the fact that there is going to be an underlying increase in fossil fuel costs that is going to be driven by carbon taxing, by availability, by commitment, jurisdictions committing to net zero and etc. I think it's one of those things. This time it isn't going to go away. 20 years ago you could have ridden through some of these price hikes and come out the other side. But I think people do need to wake up to the fact that we are experiencing increased wholesale gas prices as you are, not exactly for the same reasons, but there are interlinks in it. And so, it has become global. But I think people have got to get empowered to realise there is something that they can do, that they shouldn't just sit back and accept it as, one of those things, like it being bad weather. Oh, well, it'll be brighter weather tomorrow. I think you've got more input with this.
It's a great lead in, and that is just around the table. Like, what's our predictions on pricing, especially with climate change? How's this going to work? Is this, John, you mentioned this, and by the way, you have a lot of dialogue in this office about this. Is this a short-term blip, or is this climate change going to continue to create volatility and create pricing to go increase going forward on that?
I'm going to give you an easy answer here. If I could predict this, I wouldn't be part of this podcast. I would be sunning myself somewhere, in my billionaire's retreat. Over my time in the energy business, and I wish I could find it, a good few years back, I had a curve that somebody had produced which showed the market price at that time of oil. And then at various points, they put a spot and then they put a line showing where the general prediction of where prices would go. And more often than not, the predictions were not in line with what the market was. But I think I'm going to fall down on the side of, in the longer term, fossil fuel based prices will increase.
James, I have my opinion too. I'd be interested, James, what's your thought process?
I think that depends on where you are and the impact of carbon pricing on the market. I think you will see a greater disconnect between the price at the market and the price end users pay, especially here in Canada, as the carbon price increases. And you can see that in the US if more jurisdictions start to implement carbon prices, or if the federal government in the US implements a carbon price. There will be this bigger disconnect between what end users pay and what they make their decisions based on, and what producers make their decision based on, which is the market price of gas. And that, I think, will lead to more volatility, because you'll have a harder time balancing the market, because the market price signals won't be as strong because they aren't the major component of what customers are making their decision on. So I think you could see more volatility there. There's the side of me that says, we could see pricing drop off as demand decreases because the carbon price is increasing. And we already know what kind of the floor is for gas producers in terms of their production price. Not that that's a constant floor, and but we know that gas producers can make can make money, can be profitable at $3 a gigajoule. So as demand drops, is production going to drop, as well, as long as the price at the market is still above $3 a gigajoule? As we see that disconnect and as we see expectations for dropping demand on the production side, we might see fewer investments in production and fewer new gas wells coming online. So I think we'll see more volatility. I don't necessarily think that means gas pricing is going to be cheaper or more expensive. It will fluctuate more wildly between periods of being cheaper and periods of being more expensive. When we look at it on the weather side, I think that supports that as well, because we are seeing this kind of pattern of milder winters generally associated with climate change, but with these particular cold spells that result, again, from climate change, where weather instability in Europe is forcing colder weather from the polar circle, the Arctic Circle, into parts of North America that don't typically see cold weather. We've had, I think now, 3 polar vortexes events in the past 10 years that I don't remember ever having happened before, and this just might be my particular youth. But I think we'll see more weather instability as well, where you'll see these kind of fluctuations in the winter between mild weather and particularly cold weather, rather than what we would say a typical winter. And in the summer months, you'll see these periods of instability around the summer, where you're seeing these hotter temperatures more consistently over the summer months, increasing power demand.
So here's my take. I think we've now gone to a worldwide market because of LNG. I think natural gas will be more demand because coal plants will have to come off because of carbon reductions. I think the investment for producers will be somewhat choked off because of requirements for finance people to not lend money to carbon or fossil fuel-based people. So I think there'll be a strong demand for gas, but I think the supply side will start getting choked off, and there's going to be more demand for gas because you're going to reduce coal plants. So in my view, gas pricing will stay strong, if not get stronger. And certainly polar vortexes play a major factor. So I just think there's going to have to be a different mindset in the marketplace because of all that. So, what does that mean to consumer? Well, listen and watch markets more carefully and be mindful, be proactive. Don't sit back. That would be my take on the whole situation.
I do want to add, I don't think we're talking much about the political influence. I do think, at least in Ontario, political influence has a lot to do with carbon tax. I do remember when I was younger, I wasn't old enough to drive, so I'm not exactly sure what it was, but I remember, people hearing their parents and saying, oh, there was this one political figure that introduced carbon tax, and all of a sudden our gas pricing went up and everyone hated her. So people didn't understand that carbon tax was there because of climate change. So unfortunately, it's a big matter of education now, like being educated. And I hope, those people that were hating on her for that now can understand that was there because, our climate is really suffering from our oil and gas usage. However, some people want to keep their things cheap. And that means they would rather vote for a political leader that does not believe in climate change because, what? That being said, they're not going to be around when the ultimate effects of climate change are there.
It's true, Lysandra. Really good point. What was pleasing to see in the recent Canadian election is at least all 4 parties suggested there is climate change and we should do something. That's the first time that's ever happened.
Yeah.
That doesn't mean that's going to stay because, as you've indicated, there's politicians are going for the vote. So, but I'm hopeful that this awareness and understanding of climate change, how it impacts us, society will take that into account.
Yeah,
Yeah.
I think, Sandra, you have got a really good point there because, I know in the UK, the government regards keeping energy prices down as something that's going to make it popular as a government. And they feel that translates to votes in the ballot box more than it does perhaps to committing to net zero.
It's true. I find governments are really focused on electrical markets, but natural gas markets, they have a hard time controlling that.
Yeah.
So, but I don't know how that's going to manifest into electrical or
Yeah, I
in the
think
natural gas.
when I first read the question, like, what are your predictions on gas pricing? I'm like, obviously it's going to go up. But when you really think about it, it's never that obvious just because it's reliant on so many factors that are actually so dependent on, general society to vote on when general society isn't really in the loop about, general climate change topics.
Well, and
Go
I,
back
I
to my
think
early. Go on. If we could predict this, none of us would be sat here. We would, we would be really making money.
Agreed.
And I think
Sorry,
we are
James.
seeing the development of alternatives, and alternatives are becoming more and more cost effective and cost comparable to natural gas, especially on the electricity side. The cost of a wind turbine from a market perspective, or a solar panel, or even batteries are substantially more cost comparable to natural gas generators. And as we get more investment in low carbon and in renewable alternatives to gas generation, we would expect to see, the price of power, for example, staying flat or even declining, even as gas generation is being phased out. And we're already seeing this now, but as development and investment continues, I think we'll see more people transitioning away from gas, not because it's, the climate thing, or because it's, the right thing to do from a climate perspective, but because the other alternatives are getting cheaper. And we're seeing that, in markets, power markets already, where they're, especially in the US, they're starting to transition away from gas, even as they're transitioning to gas away from coal. You're kind of seeing the older gas plants dropping off, being replaced by new gas plants and renewable. And I think that with minimal cost impact at this point.
It's a great point, James. I think it's really critical. Just follow the money, because the transition, that's what's going to happen, is these alternative options will be cheaper, and people will just graduate going towards that direction for sure.
It does come down to the whole thing that we talk well about energy and saving the planet, which is a term I don't like. It's saving our lifestyle on this planet is the thing. But when we do all of this, if we can't make some kind of economic case for it, very little actually happens, doesn't it?
Yeah, very much so.
Well, to end off this discussion, what is the biggest takeaway you can give our listeners from this episode?
I think the takeaway here is that we're in a period of volatility. That volatility at this point is driven by some market fundamentals that have changed, but it's also driven by fear and concern about the upcoming winter. There is a good likelihood that pricing at this point is overbought, but that doesn't mean that that's not a guarantee. To echo John's point, if I could guarantee pricing will be lower over the winter, I wouldn't be sitting here. It's not a guarantee, but it is a sign that we can expect more volatility in the years to come, as we see the market get more global, as we see climate change make weather and typical patterns less predictable than we've seen in previous years. I think volatility is here to stay. And I think that means higher and lower gas prices.
Well, thank you, James. I think this episode and the previous episode, I've learned so much on the natural gas and natural gas market. So thank you for joining us. And Dave and John, I'll see you next week.
Okay,
Looking
thanks for your
forward to
help,
it.
James. Appreciate it.
Thank you, James.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360 Energy Inc. Tune into our podcast on Apple Music and Spotify by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. See you next week.